Enjoy your meeting. Just a reminder, today's meeting is being recorded.
Check. Hey everybody, good afternoon. This is David Blake, and this is our Tech Talk Tuesday. Kind of a small group this week. I kind of assumed that a lot of people are out of town. This is your first time attending. I want to thank you for joining us. We usually go about 20-25 minutes. We're going to look at some different charts, sectors, the broader market, and then we open it up to questions that you may have concerning just the broader market, or even if you want to just talk about some individual stocks, that's fine also. Okay, last week marked one of the biggest percentage moves of the years for the different indexes. Dow Jones gained 578 points, about 3.4%. S&P was up 3.3, Nasdaq up 3.6. In addition, the Dow and the S&P 500 punched through their 200-day moving average, which is a plus going forward. Every sector was higher last week. It was led by the consumer discretionary sector and the technology sector. A lot of retail stocks broke out the new 52-week highs. A few of the big technology names did also. However, what we're going to look at today is that despite the big jump, momentum in the market actually rolled over. A quick look under the hood that we're going to do today shows that things weren't quite as healthy or quite as strong as they initially appeared last week. Number one, we had internal breadth, which was actually mixed. Both AD lines on the NYSE and Nasdaq were positive, but the new 52-week lows beat the new 52-week highs every day, and actually for the last 12 days, actually counting days, 13 days, that's been the case. Okay, also showing up with some negative divergence, we only have about 12% of the stocks in our universe that are within about 2% of their 52-week high. That compares with over 20% of stocks that are within 2% of making a new 52-week low. That's what we call negative divergence, and that points to that this isn't as strong a market as what you'd like to see. Okay, another problem, and we're going to go to our first chart to look at this, is the negative divergence we're seeing in some of the underlying indicators. So I can get rid of this thing here. Just this. Click that. Okay. Okay. First, we're going to look at the some of the negative divergence in the underlying technical indicators on the charts. Now, negative divergence is when you see a stock or an index rising, like we have right over here. However, the indicators, as you can see here in the 14-day RSI, aren't in concert with the move, and actually they're actually trending lower. You saw the Dow Jones 14-day RSI just is barely at 50. Today it should probably take another leg down. That's usually a warning sign that we may be at a little bit of a short-term top. It's not exactly a sell signal in of itself. However, it is a warning sign that things aren't quite what they seem, and there could be some problems down the road. Okay, now here's the Dow Jones. I want you to see these two indicators, like I say. Number one, we had we have a 30-day stochastic, which I look at with some momentum. Even though we were up almost to the new high, we made a lower low on the stochastic. It didn't quite get as overbought as we would like to see it. 14-day, like I said, was negative, and the pullback that we saw over the last couple of weeks came down here, found support at the 31.8 or 38.1% retracement level. That's something that was actually a positive, but again, off that bounce, you want to see the momentum indicators starting to reach new highs also, which we didn't get. Okay, the same thing goes with the S&P 500. It actually looks a little bit worse. You can see the negative divergence again in the 14-day RSI. You can draw a trend line down through here. And you can see that it's stalling out at the trend line. Again, the 30-day stochastic wasn't able to push to a new high. And then you also see in the up-down ratio, we're over in here, we're towards some new high. You start to have some people taking money off the table, and it's kind of worked its way lower to sideways. again showing the negative divergence, and actually this is just showing there's more selling pressure than buying pressure on the S&P 500 currently. Okay, here's the Nasdaq. We've got a little trend line going up, but again, as we're closing in on a new high, you've got the 14-day RSI rolling over here. The up-down ratio isn't as bad as it is on the S&P 500 and the Dow Jones, but again, it's showing a little bit of negative divergence. The momentum indicator, the 14-day RSI, again, it'll probably go negative today. That still represents another red flag. Okay, lastly, here's the Russell 2000. It underperformed last week. It was only up about 2.5%. That's, of course, most of the buying was in the large cap Nasdaq stocks, the Facebooks, the Amazon, the Googles, or Alphabet, whatever you want to call it. But the small caps are still struggling to get up to the 200-day moving average, which is a little bit of a problem. It is managing to find support down here at the 50-day and also the rising trend line. This morning's sell-off came back right down to the 50-day and it was able to bounce off that. In fact, earlier today, I'm sure you noticed, most of the different averages kind of came down to their support levels. The Dow Jones came right back down to the 200-day moving average. It was off about 106 points. It's actually gone positive again, but the volume is really weak this week. It's on a holiday shortened week, and you can get some exaggerated moves on low volume days. Okay, now I was all prepared to kind of show us on the Dow Jones Transportation Index. If you've joined a lot of these talks, I keep talking about that I think this is going to hold the key to a new leg up. And last Friday, you actually did have kind of a breakout going back to somewhere back here in the summer. Went above that line. However, Monday we rolled over, and today you're off right around 1%. It was down 90 or 100 points earlier on this on the downing of this Russian jet fighter. That's really the last couple of days with the Paris deal and all this is really hitting the travel-related stocks. And I think that we're going to have to see this pop up here around this 8,300, make a run towards the 8,400 area before we are going to get this Santa Claus rally. As you can see over here, some of these stocks, here's Priceline jumping up to a new high. The last couple of weeks, you've seen this thing get destroyed. Today it came down. It was down $41. Let me see here. Yeah, it was down $40. It surged 3.25%. It kind of fell down below its 50-day moving average down here. It did find support down here around this 1230 area, but again, we're seeing some damage in these stocks. People getting out of them. Here's the Carnival Cruise Lines. Again, it had a nice run up towards a new 52-week high. The last 2 weeks, it's coming down here. It's broken down below the 50-day. Carnival's down about 2.5% today, trading down around $50, and again testing its 200-day moving average down in this area. Another one that's been getting hit lately is Delta Airlines. You can see Delta's down today. Earlier it was down about 3.5%. Looking for support down around the 200-day and rising trend line. United, Continental, Southwest, JetBlue, they're all down. Earlier they were down 3.5% to 3.8%. You can see over here the negative momentum. And again, the accumulation decline line, they're moving sideways. Okay, so that's the problem with the rally that we're having right now. And I think without participation in the Dow Jones Transports, it's going to be kind of hard to get a meaningful Christmas rally going. But there are a couple things coming up over the next 2 weeks that possibly could spark a little bit of a rally. Before we open it up to questions, I just want to touch base real quickly on the different sectors. We are seeing some negative divergence in the sectors also. Here's the materials sector. It's had a great run off the September bottom, but it hasn't made it back up to the 200-day level. It ran into kind of some resistance here at the 50% retracement from last spring all the way down to the low in September. So it's kind of running over. You're also seeing the negative divergence here in the RSI, which means points to me that I think this run is about done. Although the spike in oil today gave it a little bit of a boost. It was off the last couple of days, but the materials, the copper making new lows, gold's been kind of weak. But today's jump in in oil could give us another little bit of a pop. Okay, energy. It ran into resistance up here at the 61.8% retracement level. It's been in a downtrend since summer of 2014. Okay, we're bouncing off the 50-day moving average. Today, it's getting a bid. I think the energy level is actually up about 2% today. These stocks look cheap in here. They're cheap enough that I do think every once in a while, I told you over here, I thought you could get a bounce, but I would sell the rally. I would. It's possible you could buy some of these oil stocks that are beaten up down here again, and maybe get a little bit of a bounce over the next few days. I would probably sell the rally if it gets up in here close to the 200-day. Next, we have the financials, and over in here, we've been telling you for the last couple of weeks that we'd be buyers of the financials. We've gotten a nice run, had a little bit of a pullback here, and now we're up here testing testing the highs again. The bank stocks are still cheap, but I think you might want to consider selling the news in December if we get another run up into the rate hikes. The problem with that, I think why I'd want to take a profit into that. Number one, I don't think the quarter point hike in rates is going to do much for the banks. But more than that, we're also starting to see a little bit of a flattening in the yield curve, and that's where the banks make the money when they when they make the money between the spreads of the shorter term and the longer term. And if we have a flattening of the yield curve, it's going to cut in on the banks. And I think that that may be a case in this with the financials that you sell the news going into December. Okay, industrials. I've been a little off on industrials. I don't like exactly much of what they've. I don't like the sector that much, mainly because I think with the dollar getting more support, that's going to weigh on the industrials, especially the multinationals. It's going to weigh on some of their earnings going forward. You've had a nice run in here, and quite frankly, generally when you get this much of a retracement, you usually get a little higher. Now you are seeing some negative divergence, and I think that what you've seen here lately, I'm going to show you a couple of these stocks, is you've had quite a bounce after the terror attacks. Here you can see Raytheon. Raytheon makes the cruise missiles, which could come into place again. Every time we have a terror attack, you see a nice spike in Raytheon. The symbol's RTN. You can see the breakaway. Here's from last weekend. It was going sideways. Once the Paris attacks hit, it went higher. It was higher. It was actually kind of spinning its wheels today, but it could be moving higher. Here's another one I like, Lockheed Martin. It's had a nice run in here. Again, it was rolling over. The terrorist spikes hit. Boom, it moves higher. That also pays about a 3% dividend. So you may want to take a look at some of the defense and aerospace stocks as a place to move some money into the industrial sector. Okay, here's the technology sector. Almost made a new high here, 52-week high a couple weeks ago. Again, what you're seeing here is the big cap stocks like the Facebook, the Alphabet, Netflix, Amazon. They're poised to look like another move a little bit higher. I like this sector. Negative divergence still, however, the up-down ratio means you're seeing some money coming in here lately. And I would be, if I'm going to be in this market, I want to own some of the technology stocks. And again, more likely the larger names at this point. Okay, here's a consumer staples. Not a bad-looking chart. Had a big sell-off over here. A lot of that was due to some of the stocks like Procter & Gamble and some of these multinationals that got hit kind of bad. I would be selective in this group. What does look good to me, I like some of the beverages look good. Budweiser has been moving up. I also like some of the tobacco stocks. I'm looking at a couple of those today. One symbol is VGR. Another one is UVV. They have some nice looking charts on them, and they look higher. Okay, here's healthcare. I still like that. You're battling that 200-day moving average and a descending trend line. If we can get above the 200-day moving average in healthcare, I think you can move higher. You can see the RSI is a little bit negative divergence, but not too much considering that they've been kind of in a trend here going sideways. I think what's holding healthcare back is the drug pricing wars that you're talking about. That could keep a lid on these for a while, but once that starts to take some of the uncertainty out, you can see a nice move in the healthcare stocks. Lastly, here we got the consumer discretionary sector, a nice spike up on that. I like this sector. Retail stocks, although you have to be selective, but stocks like Home Depot, Costco, they're doing well. Breaking out to new highs. Here's Nike. You got to love Nike's chart. It came down here, bounced off the 50-day, up here trying to get new highs. You have Home Depot, another great trend. Great earnings report, up-down ratio. You've had a lot of buying going on in Home Depot. I'd be buyers of that stock. Here's Starbucks, another great-looking chart, just rising straight into this. You've got some nice accumulation in here. Momentum starting to pick up. You bounced off the 50-day moving average here a couple times. Look like you're going to break out higher. All right, just to kind of wrap things up, what I want to do, there's a little bit too much divergence, negative divergence in the market right now to get real excited. It's possible that the end of the year rally could have already happened. However, there are a few political economic events that are going to be going over the next few weeks that actually could move the market one way or the other. Next week, the ECB is expected to announce additional quantitative easing plans. I believe that's on the 3rd. That is probably going to hit the euro and send the U.S. dollar a little bit higher. They're calling that may be the item that pushes us into parity with the euro. Interesting to see that. European markets could get some traction on that news. How our market will be affected by that, it's kind of hard to tell because when you get some strong moves in the dollar, it kind of rolls things over. And also, of course, our Fed meets on February 16th. I'm going to close this out and share the chart. And on the 16th, that could lift the market initially because traders might want to sell the news as it takes out some of the uncertainty of the market. But I do know if they don't do anything and they decide that the economy is not strong enough to warrant a rate hike, even though it's just a 1/4 of a point, I think that you can see the market sell off hard because it would cause the Fed to lose more credibility. And okay, I'm going to come down here now and share this. What I want to do is try to open this up to some of your questions. We'll look at some of the charts on here. And can you see the chart right now? Can't?
You keep shutting it down.
Okay. Let me try to see if we can get this screen share. Okay. Start. I see we do have a couple questions, so we'll open this up. Okay, so we get the charts up there. I guess you can see those now. Okay, we're all set with that. Okay, let me see the questions that we have on here. Okay, the preference in the Europe market in terms of ETFs are large versus small companies or specific companies. Okay, one thing I want to point out that, about Europe, and this is, I do like some of the ETFs over there, but there's something that you want to take a look at. Not all these European ETFs are equal, and that is you want to look for ETFs that are priced in the euro, not dollar. And the reason being, because if you buy an ETF that's priced in U.S. dollars, when you convert it back over here, you're going to lose money. You could lose as much as, it could underperform an ETF priced in euros as much as 8 or 9%. So that is very important to keep that in mind. You have to read the description of the ETF for that to find out to make sure that it is priced in euros. But that again, that can cut 7 or 8% of your gain returns off if you have it priced in dollars rather than euros. So make sure you read the ETF about the description of it to make sure you buy that in euros. Okay, consumer staples has been up and down this past month. What's the long-term trend? Okay, the longer term, it has been in a sideways range. Here's the 1-year chart. However, if you look at going out 3 years, we're still still in a basic uptrend. You can draw a trend line in over here, going out, let's go over here. I think if you can get down here around 47 or so, you might have some problems, but you're seeing some accumulation down here in the up-down ratio lately. Consumer staples, like I say, you've got sections of it that are good, but you have to be in the right thing. I don't think that it's just a buy. I wouldn't buy XLP in itself. I would look at maybe going more industry group sensitive, and that again, like the beverages are outperforming right now. The tobacco stocks are outperforming. You actually go, if you look at the Market Edge industry group and the advanced tools, you can actually see which industries in that sector are outperforming. Okay, COP up 2 points. Would you be a seller in strength today? This has actually been one of my I did like this chart earlier. I would see where we are right now. COP is we're up 2 points right now, 55.26. I would let this run a little bit longer. You're up 3 3/4% today. I would let this Mideast stuff just spread out. Take a couple of days. I would be a seller of this stock though, up around 57. You're at 55 and 55.30 right now, but I think you could probably move a little bit higher on this one. And you see you are in accumulation over in here right now. So no, I would let this run a little bit longer, but I would take my profits around 57 on a short-term trade. Okay, when you speak of low volume, how many shares traded in the Dow, S&P, and Nasdaq are considered low volume days? Well, I would say yesterday we were down about 25-30%, and probably today, I'm not sure how the volume is today. But the problem with low volumes selling is it's not so much that the low volume actually causes a fall or a rise. You get exaggerated moves because sometimes you don't have the other side of the trade coming in. You get a lot of traders, if they start to see the market selling off, they like it, the broader market, they can move in, they'll start buying up shares. On the low volume days and holiday weeks, a lot of those guys may be out of the office and they're just not in there to support stocks or indexes where they normally would find support. But tomorrow you'll be down 50% on the normal volume. And Friday, of course, is a half day, and it'll be probably less than 50%. Today's volume actually is probably a little bit better than normal, and that's because of the gunning down, the Russian jet getting shot down. You probably had some people come in, but you're for half a day, you're a little bit up today than what you would be without that problem. Anybody else have anything? I don't see anybody typing. I don't expect to see a heck of a lot of movement either way the next couple of days, unless we have another jet get shot down or something like that. But with that, we'll wrap it up. A link of this will be on the screen on the markets page on a link probably in about an hour or so. Other than that, I wish you all a happy Thanksgiving. Hope you get to spend time with your family and loved ones, and enjoy the rest of the week.